Hello and welcome to the investment review for August 2015, which I've put together in view of the current difficulties that we are witnessing in markets. It will not be lost on any of our clients that markets are currently in significant turmoil. I've therefore prepared this review to give an overview of current thinking, but also to give consideration to the portfolios that most of our clients are invested within. In each case, I've made a comparison in the following graphs to the relevant investment sector. In the case of a risk-free profile, this would be known as a cautious managed investment, and in the case of a risk 5, this would be a balanced managed investment. We never seek to celebrate falls in the market, but it is reassuring to see that our diverse approach is affording us some protection from what we hope to be a short-term market correction. Please do go on to read the rest of this review, as it contains some relevant historic information. Whilst we cannot rely on events of the past to provide us with certainty as to what may happen in the future, we do have to give consideration to probability resulting in something of a repeat of the past. So what's been happening? More than £130 billion has been wiped off the FTSE in 10 days, and that's before the downturn that we're witnessing today, as Beijing is set to resort to drastic rate cuts to revive its flagging fortunes. The FTSE 100 capped off a frightful fortnight, which has seen over £135 billion wiped off from the index as investors were rocked by renewed fears of China's economic hard landing. Britain's benchmark index closed down 2.83% at 61.87 on Friday, ending a ninth consecutive day of falls, which has led its descent into official correction territory. The index has now fallen by more than 13% since hitting a high of 7,104 in April. The panicked sell-off was sparked by another round of disappointing data from China, where factory output contracted at its fastest pace since the height of the global financial crisis in 2009. The latest wave of flagging growth indicators is set to force Beijing into drastic action to revive its fortunes, 2 weeks after the authorities stunned markets by weakening the renminbi and setting off an August market rout. There is now a high probability that the Chinese central bank will move to slash the country's main lending rate, said analysts at Societe Generale. We can really see what happens when panic sets in, because the panic selling has also hit US stocks, where the S&P 500 fell below the 2,000 mark for the first time since January, putting equities on course for their worst week of trading since 2011. Their benchmark index closed the day down 3.2% at 1970 as soft manufacturing data from the US added to global growth woes. Broader European markets also suffered their worst week of the year. The pan-European FTSE Euro First 300 capped off a torrid 5 days, falling more than 5%. Germany's DAX was down by 3% on Friday, while the French CAC 40 declined by 3%. European indices were driven lower on a resumption of Greece's woes after the Prime Minister resigned from office, calling for snap elections for the 20th of September. Hard-left rebels within the Syriza party announced the formation of a breakaway anti-bailout force called Popular Unity, made up of 25 MPs. This makes them now the third largest party in the Greek parliament. The rebels, who are led by their sacked energy minister Lafazinis, will seek to club together with far-left forces, including the Communist Party, to form a minority government over the next 3 days. He has promised to stick by the elected promises abandoned by their former leader after he was forced to capitulate to creditors' conditions to keep Greece in the Eurozone for at least another 3 years. The former minister, who boasts close ties with Moscow, vowed to take the country out of the single currency in a planned exit. So this Greek issue really does roll on. After 5 years of international bailouts, Greece has undergone the most severe depression of any developed economy in the modern era. They have quoted, "We won't accept being in the euro area and having bailout programmes imposed on us." But the prospect of a minority government of either the hard left or Greece's pro-Euro centre right forces is unlikely. Syriza remains the most popular political force in the country, with polls suggesting that Mr. Tsipras is set to remain Prime Minister should elections go ahead next month. We have to consider what to do. The next few charts serve to demonstrate what has happened in the past after various market corrections. It is evident that markets have always recovered. None of us have forgotten the troubles of 2008 and 2009, and it is not thought that the current issues represent anything nearly as significant. Concerns largely focus on the Chinese economy slowing down. This is exacerbated by the US Federal Reserve announcing their contemplation in increasing their interest rates. This would only serve to strengthen their currency and thus make it more expensive for China and other emerging countries to export goods to the USA, which, as you can appreciate, is a huge market for their exports. There is a counter-argument gathering momentum suggesting that after the significant slump in oil prices and broader commodity prices, inflationary pressures are in fact easing, and this actually pushes the spectre of an interest rate increase further down the road. Our advice is to sit tight. There is no value to be had in switching out of markets which have fallen. Our strategy is an investment strategy and is designed for the medium to long term. As I have mentioned in earlier reviews, this type of volatility is to be expected occasionally. I appreciate, of course, that it creates disquiet and understand that none of us appreciate witnessing a fall in the value of our investments, albeit hopefully temporary. This is the risk-free graph, which hopefully is self-explanatory and shows what our typical lower risk investor has experienced over 1 month, 3 months, 6 months and 1 year. This chart shows what our average medium risk investor will have experienced over the same periods, i.e. 1 month, 3 months, 6 months and 1 year. In the next chart you can see where the FTSE 100 last fell by a similar amount to the falls we're currently experiencing. This chart shows that within around 16 or 17 weeks from the lowest point, a full recovery was staged. There is a significant raft of data available to show that this situation is oft repeated. What is also important and is noteworthy is the volatility that exists in markets, which can be seen in the sawtooth shape of the line. If we speculate during this very volatile period and try to cool the market by pulling funds out and going back into markets later, it can quite easily amplify any losses that had been made in the first instance. I need to reiterate that we are not seeking, when we give financial advice, to play markets. We are instead designing a medium to long-term strategy where our aim is to improve upon returns that can be seen in alternative saving areas, for instance, and primarily cash. We use the FTSE 100 chart in amongst some of these updates simply because this is the chart that is referred to in the spectacular news items that cause clients concern. Our earlier charts show that a diverse approach limits the effect of single market falls. And here is the chart referred to in the last slide, showing the recovery after the last major correction of the FTSE 100. In summary, we continue to believe that our mix of investment portfolios is suitable. We also believe that the correction has a short-term outlook. Corrections like this are often made to look worse when markets are trading low volumes, as is the case during summer holidays. Many fund managers will no doubt be looking upon this as an opportunity to extend their holdings, as it is always their preference to buy when markets are lower. Our contact details appear as usual on the final slide, and of course if you have any immediate concerns, please do not hesitate to contact us. Thank you for listening.